Greetings. My name is Michael White. I'm a construction risk advisor and surety underwriter here at IFB Insurance Services. Today, I am here to talk about surety bonds for construction contracts and building a solid surety relationship. As an appointed SBA surety bond guarantee agent, IFB Insurance Services' aim is to provide surety bond readiness to small and emerging contractors by processing the necessary documentation to obtaining a surety bond for federal, state, and local construction projects. Through our surety partnerships, we work with construction contractors to obtain bid, performance, and payment bonds that are not available to them in the traditional commercial marketplace. History of the surety industry. The origins of a surety bond goes back to 1935, the Miller Act, and it is a federal law that requires contractors performing public work projects to obtain performance bonds as well as a labor and material bond for any projects that exceed $100,000. A bond is a financial guarantee, not insurance. It's there to protect the public sector agency, and the indemnity agreement protects the surety from any losses or default that may occur by the contractor. What is a surety bond? A surety bond is an agreement between the construction business, the surety company, and the project owner. Sometimes we like to call them the obligee. The type of contract surety bonds are bid bond, performance bond, payment bond, and maintenance bond. A bid bond is provided to the owner to give assurance that the contractor, if he is the lowest and responsible bidder, will provide a performance and payment bond. A performance bond is a promise that the contractor, throughout the term of the contract, will complete the project 100% according to the plans and the specs. A payment bond is a guarantee made that the contractor will pay all of his creditors for any materials on the project and labor costs and any other services that are associated with the contract. A maintenance bond is a warranty. Usually, if the owner wants a warranty beyond the 1-year period, a maintenance bond is usually called for. Usually the max time on a maintenance bond is 3 years. Let's talk about surety bonds versus traditional insurance. As I've mentioned throughout my presentation, a surety bond is a 3-party contract versus traditional insurance, 2-party contract. Surety bond, surety bonds, risk transfer versus traditional insurance, risk transfer. Risk transfer is a risk management and control strategy that involves contractual shifting of pure risk from one party to the other. As for a surety bond, if a contractor happens to default on a contract, then that risk is shifted to the surety, where the surety has the obligation to complete the project for the owner. Whereas insurance, in a two-party contract, the insurer is obligated to pay any loss that may occur to the insured. Duty to the obligee versus traditional insurance duty to the insured. Duty to the obligee, the surety has the duty to the obligee to resolve any claims, issues, or disputes throughout the term of the project, versus duty to the insured, where the insurer has the duty to provide and resolve any claims made by the insurer. Surety bonds and traditional insurance is both regulated by the state departments. Surety bond premium fee versus the traditional insurance premium actuarial determined. The premium fee for a surety bond is determined on the final cost of the contract, since there is no charge for the bid bond. Versus a qualified person, which we call an actuarial, would calculate commercial risk and probabilities involving uncertain future events. A surety bonds project specific is a contract that outlines the contractual duties of the contractor that he guarantees or pledge to complete the project in a timely manner, versus term specific in a two-party contract between the insurer and the insured, provides coverage for a certain period of time or a specified term of years. Penal sum, similar to the insurance policy limit, the penal sum represents the maximum amount a surety company will pay under a bond. The amount of the penal sum is typically stated as a percentage of the underlying contract price. The required percentage will vary based on the type of the bond. Mitigating loss. As I mentioned, a bond is a three-party contract. There's an indemnity agreement that is put in place between the surety and the bonded contractor, which he has to sign both corporately and personally. That contractor then will perform the duties of completing the project. And if the contractor happens to default on that project, the surety will resolve all claims to satisfy the obligee. Let's talk about qualification for bonding. In the surety world, we like to call it the 3 C's of bonding: character, capital, and capacity. Character is history of prompt payments by the contractor. We look at his credit score, both business and personal, his career experience, how long he's been in the business. Capital, financial strength, good standing in the community, ability to meet current and future obligations. What is his personal net worth? Does he have the capital to complete the project? And capacity, equipment and staff to perform the work. Let's talk about underwriting considerations, the things that we take into perspective. We usually ask for sound financial statements, which involves balance sheet, profit and loss, cash flow statements, balance sheet, and aging of accounts. Also, is the contractor committed, and does he have the competent personnel to complete the project? Personal and corporate indemnification. Is the contractor willing to both sign corporately and personally to indemnify the project? Submission requirements that we usually ask for in evaluating your request for a surety bond: contractor's questionnaire, business financial statements for the past 3 years, corporate financial statements for the past 3 years, a personal financial statement of each owner, current work on hand schedule of projects that are currently going on, lines of credit and bank references, resume of all key personnel, a copy of your general liability insurance, bid, performance, and payment bond request. If you would like more information, and if you'd like to have a one-on-one conversation, I can be reached at the following number, or you can email me. This concludes my presentation, and I look forward to you reaching out to me. Have a good day.